I'd now like to invite you, Nitish, to come and build on that, if you may. So I know Everest has got a load of research as well, looking at what's happening on a macroeconomic level around the world. So do you want to build, or do you want to contradict any of these figures? Feel free to give us your view.
Absolutely. So Kerry, thanks for inviting me. And I think in most cases, I will confirm what Steve's saying. And by the way, Steve's a tough act to follow, but I'll try. So we'll talk a little bit about, we'll unpack the onion. We'll try and go into details around how the broader macroeconomic events that we're seeing and how clients are now using that to influence how they spend on technology and broader digital transformation and the kind of models that they're adopting to do that since. So, for anyone who's not familiar with Everest Group, we're a global research and advisory firm, and we track technology, business process, and engineering services markets. I personally lead as a partner our focus on UKI and Europe, and work with clients who are either buying technology, selling, or enabling technology, as well as folks who invest in technology. So really working at the intersection of this ecosystem, and then focusing on the first stack that you see here, which is around technology, which includes application services, cloud, products and platforms, and the broader digital transformation landscape. So what are we going to talk about today? We'll talk about three things, and I have an interesting two-part agenda. So, I'll first talk about the first two things on the slide, which is really how is the technology services market performing, what's really happening given the macro backdrop, but also how resilient is this spend given the choppy waters that we are heading into. And then, I'll hand it over to a fellow panelist and come back with the outlook for the next 12 to 24 months, building on from some of what my fellow panelists will say about sourcing models and so on. So let's dive into this, given we have a packed agenda. And the last thing people want to do is go through a ton of slides on a Tuesday. So let's first talk about how the broader macroeconomic backdrop is influencing digital transformation. And spoiler alert, we still believe the digital transformation market to be fairly robust despite what's happening macroeconomically. And there are two things that are happening which are interesting. We believe we are actually seeing a new age world order in technology influenced by obviously what's happening geopolitically, but also on technology consumption. The first thing is what I would describe as the hyperscale effect. So when I say hyperscalers, a lot of people naturally, and for the right reasons, think of the large cloud providers, AWS, Azure, Google Cloud. But we also believe these hyperscalers in different markets around data, around experience, and obviously around IT infrastructure, which is what we know of mostly, are creating a new wave of adoption for clients who are trying to transform using digital technologies, because they're interoperable, they're supposed to be distributed, and they're they can be consumed in an as a service model. So we're seeing this to be a new shift in the way clients consume this, but also transform their businesses. Just to give you a sense, and AWS is growing at 30% or more on an annual run rate of $74 billion. Those figures at that scale haven't been seen in technology or technology services in the past, not even in the ERP boom of the 80s, 90s, or the early 2000s. So this is something unique. At the same time, we're dealing with an increasingly volatile world. I don't need to go into a lot of details around this. I know some of my fellow panelists will talk about this as well. But if you really think about the impact, both from a demand and supply perspective, Steve spoke a lot about demand, some part of supply as well. But if you really think of supply of talent for technology and technology services, both have been impacted in the last 12 to 18 months. So the combination of these factors is what's causing a rethink as clients think about their next priorities. And you see a word cloud of the key issues that they're grappling with. Having said that, it's not all bad news. We do see the market to be fairly resilient right now. This is an interesting chart, so let me break it down. This looks at organic and constant currency growth for the global technology industry using the top 20 publicly listed IT services businesses as a proxy, right? So this represents about $450 billion of technology services spent. And if you really think about this compared to pre-pandemic, right, and I'm conflating this with what Steve mentioned around GDP, we actually think, and we are seeing that the technology services market has actually accelerated and gone beyond its pre-pandemic growth. So we saw that it was decelerating a little bit going into 2019. And now, if you just look at the first calendar quarter this year, and now we have increasing data for H1 as well, we see the base affected adjusted growth to be higher than pre-pandemic. So that's something to cheer about. If you really think about the broader industry, again, using the same peer set I mentioned earlier, we see that by March this year, we ended at somewhere around 6.7%, up from a high of 12.4% in the first calendar year quarter. So till March next year, we believe the market is going to decelerate a little bit. Having said that, this is a deceleration in growth. This is not a decline. We still think it's a net positive market. It's just that the base of 12.4% growth, which was being compared to 2021, is not sustainable. But what's also happening very interestingly is this number is misleading, because if you really look at the leading service providers, so these would be the larger service providers who are contributing to this growth, they're actually growing much higher than the market average. So they're growing at about 19%. If you just look at Accenture, TCS, Infosys, Wipro, HCL, and now the newly formed IBM Consulting. So in some ways, this is very unique because the larger players who you'd expect, because of their bigger books of businesses to grow slower, are actually leading market growth compared to what the rest of the peers are doing. And if I take a look at pipelines for the industry, again, from a supply perspective this time, you'll see both in terms of the industry growth on the top left or the book-to-bill ratios. We see, again, the industry accelerating and going beyond pre-pandemic levels. So the industry book-to-bill ratio, which is generally a good measure of pipeline and sales momentum, is at about 1.1x till H1 this year. And we are just in a round of busy earnings season right now, and we see that to be about 1.2x of the industry. And that reflects some of the growth guidance that providers are giving as well. So the summary is, we're in a fairly robust period of economic growth, which has resulted in a lot of pent-up digital transformation spend. But we obviously know that there are fears and uncertainty as we get into the next few quarters. So what does that really mean? So one of the things we ended up investigating over the summer is technology spend really becoming recession-proof? A lot of these markets tend to be a reflection of what's happening from a macro perspective. So we wanted to bust or validate that myth. So we ended up doing something interesting, and I would encourage you to follow, given this is a busy slide, just the blue and the red solid lines. So ITS represents IT services growth, so similar to what you saw earlier. But this time reported growth, not just organic and constant currency, and GDP represents the average GDP growth for about 48 major economies, I would say mostly the Western world. And now, if you really think about it, for most of the last 5-6 years, and this has been true since actually the great financial crisis of 08-09, we saw GDP growth and technology services spend to be neatly correlated. But the last few quarters, something interesting has happened, and we see this happening in this year as well, where GDP momentum and sentiment, and we saw it in the first part today as well, has gone down, but technology services spend still remains robust. Why is this happening? Why is this disconnect? And we believe there's been a decoupling in GDP and tech spend, and there are 3 reasons why. One, we believe technology is a lot more central to life and business now. Just think about your life in the pandemic, Zoom calls for personal reasons, but also keeping businesses alive. Think about how technology and data was at the forefront of the response to the pandemic, whether it's providers or on the hospital side or in terms of the vaccine development. The second, we believe this is a slow-moving march to a recession. And Steve can keep me honest, as can others. If you look at previous crises or the ones in recent memory, whether it's the great financial crisis 14 years ago or the pandemic a few years ago, they happened fairly quickly, within the space of a few months or a few weeks in the case of the pandemic, or a quarter or a few months in the case of the great financial crisis. This crisis seems to be a lot more slow moving, because I can certainly recall conversations starting May or June this year where we've been talking about a recession. So that's given businesses and suppliers more time to prepare for this. But I think the last thing which is really important, and again, we saw it in the first part, is this hyperinflationary environment. We believe this environment is a unique skill set for a lot of organizations. Unless you've been in business for the last 40-50 years, you've not seen this environment, because the last time inflation was so persistently high was the late 70s to the early 80s. So living in an economy with that is a unique challenge. So we do believe going forward, some of this is going to slow down. So we believe some of the growth that is happening in technology services is not sustainable just because the market was so hot. So we do believe that is going to slow down from about 10.4% to about 6.7% till March next year. Again, organic and constant currency. Reported revenues will be higher just because, foreign currency and, given the strength of the dollar right now, behaves very differently, and M&A can also contribute. But if you really break it down by regions, we expect Europe to bear a lot of that brunt, unfortunately, just given our proximity to, what's happening, the humanitarian crisis and the war in Ukraine, but also the ensuing energy and food crisis that the continent is going through. So we do expect that to slow down from 9% to 3.7%. We expect North America to be a little bit more resilient, but in our past modeling, we've seen that North America, from a technology perspective, tends to have a few quarters of lag. So in terms of, what emanates in Europe can often have a snowball effect later in North America, but not at the moment. So I'll end with my last point, and then I'll hand it over to the next panelist before we talk about a forward-looking view. We see enterprises testing now the market for some cost optimization. And we did some interesting analysis. We looked at a basket of companies across different sectors. So Walgreens Boots, PepsiCo, and you can see more on the footnote. So this includes some financial services, some healthcare, just to get a sense of where people are. And we saw operating margin for this basket of companies, observing them for the last 18 months, come down from 22.7% to 15.2%. So that's a significant decrease. Having said that, that's still not resulting in them slowing down technology spend. We believe there are two reasons. One, a lot of the initial cutback that's happening is on what I would call direct services that they procure. So think of all the bottles you need to procure as a PepsiCo, the raw materials, and also the volatility in supply chain. So the direct services that they procure is where a lot of the initial savings are coming from, or that's where the focus is going. And the second thing we also think which is stopping them from reducing technology spend is we believe they think that technology, and for the right reasons, is their way to also bounce back from this crisis. So they want to make sure they accelerate through this. They don't want to put the brakes on in terms of emerging in a more resilient fashion. So we expect to see that, and I think we will continue to see that over the next 2 to 4 quarters. So with that, this was really a view on where we are and what we're seeing. Kerry, I'll hand it back to you. I know we have some interesting content, and then I'll come back for a 2-minute wrap up. So, Kerry, as you rightly said, we've spoken a little bit about the macroeconomic backdrop. We've spoken about sourcing model. We've spoken about what's happening in digital transformation. But what does that tell us about the next 12, 18 months? So I have 4 or 5 key things that I want to share with the audience. And this is how we think clients are responding to this new world order that I spoke about, the impact of both technology shifts, and also the geopolitical and the macro uncertainty. The first thing that we're starting to see is from a pricing or a cost perspective, clients are not willing to pay blanket price increases. We've spoken about wage inflation. We've spoken about the dearth of hot technology skills in specific roles. So clients are taking a more nuanced approach when they think about how they contract and how they price. So they're really focusing on roles. So with skill sets, demand higher pricing, where they know where can they go higher, by how much, and who do they go with. That's the kind of pricing discipline that's coming in. I think we expect that to continue given the macro tightness. I think a natural consequence of that is also going to be about how they evaluate and evolve or change their contracting models. Again, clients have become more sophisticated, and this is, maybe enterprises and clients who are in, generation 2, generation 3, and more of the contracts, where they're distinguishing what they pay for run the business or keeping the lights on kind of services versus what do they pay and how do they pay for those services that help them change their businesses, right? So if you're a large retail bank and if you're trying to start a digital or a neo bank, how you architect the contract around that is different. And I think going back to Marek's point, we do see an expansion in how they think about internal talent. So the use of GBS models and specifically use of certain talent hotspots to fuel that. The third thing we're starting to see is, overall, there's been a pressure on deal terms and deal values. There are, yes, some large and complex deals out there, but there are a lot of contracts that are now becoming shorter and smaller. And some of it is just because clients want to get stuff done quickly. They don't have nobody has a timeline for 24 months to implement a CRM anymore. They want everything done quickly. And some of the pandemic experiences have also reset expectations. But there's a second big factor, which is the market volatility. Just given what's happening in terms of inflation, wage costs, and so on, clients feel that if we get into a full-blown macroeconomic event in the next 2 to 3 quarters, they will be able to get a better deal from their partner. So they're also trying to hedge against that while keeping up transformation. And the last thing, and which I think is becoming really important. And I mean, maybe this should have been the first thing we think about, is we're starting to see finally, and I'm glad to see that clients are paying more than lip service to sustainability, and specifically from a sourcing process, they're now embedding this in the process itself. So earlier we saw clients asking, questions in the RFI or RFP situations where maybe they asked one or two line items in terms of the sustainability credentials for a provider. That weightage in the process has gone up to a lot more. I've recently seen a process where the sustainability credentials were up to 25% of a partner's selection criteria, which is a massive amount. But then I think the second way they're also using providers and asking providers these questions on is not just how green or how sustainable you are, but how can you help me achieve my sustainability and ESG goals across people, planet, and business case elements. So I'm glad to see that we're paying more attention to sustainability and ESG, and I think this will continue. Back to you.